Picture the scene. October 1907, Wall Street drowning in panic, and Jesse Livermore staring at a telegram that would reshape his understanding of speculation forever. The ticker tape rattled with Union Pacific's relentless decline, and Livermore had just closed his short position for a respectable $250,000 profit, feeling satisfied with his market timing during the financial chaos. But that telegram contained calculations that would haunt him for decades had he simply held his position. Instead of taking profits, he would have banked over $3 million as the stock continued its merciless plummet. This wasn't just a missed opportunity. It was a revelation that even the most intuitive market mind of his generation was systematically sabotaging his own success through a psychological flaw that destroys traders at every level of experience and expertise. The irony cuts deep because Livermore possessed an almost supernatural ability to read market sentiment and predict major moves, yet he repeatedly fell victim to the same trap that plagues every speculator: the overwhelming compulsion to secure profits before they evaporate. What makes this story particularly fascinating is that his premature exit wasn't driven by traditional fear or greed, but by a fundamental misunderstanding of how genuine market trends actually develop and express themselves over time. His bucket shop apprenticeship had conditioned him to scalp quick profits from short-term price fluctuations, developing lightning, fast reflexes that served him brilliantly in those gambling parlors, but became a devastating liability when dealing with authentic market campaigns that could run for months or years. The bucket shop mentality had programmed him to view every profitable move as a gift to be immediately harvested, rather than recognizing these advances as early signals of much larger trends yet to unfold. His private journals from this period reveal a man wrestling with a profound internal contradiction. His tape reading skills clearly indicated the market wanted to decline much further, yet his ingrained habits compelled him to bank profits at the first sign of meaningful gains. This costly lesson crystallized into Livermore's most valuable insight, captured in his famous confession: "It was never my thinking that made the big money for me. It always was my sitting." This deceptively simple statement represents a radical shift from active prediction and constant intervention to strategic patience and disciplined endurance. Livermore began to understand that the market's most profitable moves often start with modest advances that feel comfortable to exit, but these early stages are merely the foundation for campaigns that can multiply initial profits 10 or 20 times for those with the psychological fortitude to participate fully. The Union Pacific debacle taught him that successful speculation isn't about predicting market direction, which he had already mastered, but about developing the mental framework to let profitable positions reach their full potential without interference from natural profit-taking instincts. The core tension emerges clearly. If a trading genius like Livermore, with his unparalleled intuition and market-reading ability, repeatedly sabotaged his best ideas through premature exits, how can ordinary traders hope to avoid the same fate? This paradox demands a systematic solution that transcends gut feeling and emotional impulses. Livermore's eventual breakthrough relied on mechanical signals derived from price action and market structure that removed guesswork from hold emphasis, sell decisions, allowing him to participate in major trends without the psychological torture of watching paper profits fluctuate while maintaining conviction. His transformation required developing what he called pivotal points and understanding the market's line of least resistance, concepts that would become the foundation for staying in winning trades longer. This systematic approach was built on three critical anchors. Price must confirm the trend's continuation, volume must validate genuine institutional participation, and time must allow the move to breathe and develop its full potential. Without all three elements aligning, holding becomes mere stubbornness rather than disciplined speculation. The promise for modern traders is profound. These same mechanical frameworks can be learned and applied without requiring Livermore's intuitive genius or his expensive bucket shop education. The techniques that transformed him from a talented but erratic scalper into history's most successful trend follower can become a repeatable methodology for anyone willing to replace emotional decision-making with evidence-based position management. But Livermore's early mistakes weren't random. They revealed a critical gap in his market understanding that would take years to solve. beginning with his revolutionary discovery of what he termed the line of least resistance. Livermore's painful Union Pacific lesson revealed a critical gap in his market understanding that would take years to solve, beginning with his revolutionary discovery of what he called the line of least resistance. His bucket shop apprenticeship had taught him to read individual price movements with lightning speed, but he lacked a systematic framework for distinguishing genuine trend continuation from temporary market noise. The solution emerged through his development of tape reading, a discipline that transformed the continuous ticker tape from mere numbers into a sophisticated language revealing institutional buying and selling patterns that could persist for months once properly established. The tape, to Livermore, became the market's heartbeat, whispering supply and demand dynamics that amateur speculators completely missed while chasing headlines and tips. His breakthrough insight centered on understanding that markets, like water, always follow the path of least resistance. When large institutional interests finished accumulating substantial positions over weeks of quiet buying, their subsequent actions would push prices decisively upward until those positions were fully distributed. Conversely, when institutions began systematic selling campaigns, prices would decline with minimal resistance until accumulation resumed at lower levels. The key was recognizing when this institutional activity had reached critical mass and was ready to express itself through sustained price movement rather than random daily fluctuations. Livermore's 1915 Bethlehem Street Eel campaign provides the perfect laboratory for understanding this methodology in practice. The stock had spent 7 weeks consolidating between $42 and $45, displaying classic accumulation characteristics that most traders dismissed as boring sideways action. During declining days, the stock printed narrow ranges with contracting volume, while advancing days showed wider price spreads with expanding turnover. This pattern revealed professional interests quietly building positions without creating obvious buying pressure that might drive prices higher prematurely. When Bethlehem Steel finally broke above $45 on volume, running 2.3 times its 10-day average, Livermore recognized this wasn't another false breakout, but genuine institutional sponsorship expressing itself through decisive price action. The stock opened strong, maintained gains throughout the session, and closed near its daily high, while demonstrating superior relative strength compared to other industrial names. These weren't coincidental technical factors, but evidence that large interests possessed both the conviction and financial capacity to sustain the advance over extended periods. Livermore's genius lay in developing what became his three-pillar confirmation system that removed guesswork from holder versus sell decisions during profitable campaigns. Price confirmation required movement in the direction of least resistance, meaning advances should feel effortless while declines met consistent buying support at logical structural levels. Volume validation demanded that genuine moves demonstrate expanding participation, with institutional-sized transactions driving action rather than retail enthusiasm or panic. The time factor recognized that profitable trends need duration to develop full momentum, typically requiring weeks or months rather than the days or hours that characterize amateur speculation. This technical foundation became crucial because it provided objective evidence that could override emotional impulses destroying most trading campaigns. When Bethlehem Steel pulled back from $48 to $46 after its initial breakout, amateur traders probably panicked and sold, fearing they would give back paper profits. But Livermore's tape reading skills revealed this was normal profit, taking rather than trend failure. Volume contracted on the decline, the stock held decisively above its breakout level, and relative strength remained positive compared to the broader market. These mechanical signals indicated the line of least resistance remained upward, despite temporary setbacks. Most traders exit winners prematurely because they fundamentally misread this normal profit-taking activity as trend reversal signals. Every healthy advance experiences periodic selling from short-term speculators capturing quick profits. But these surface reactions don't invalidate the underlying accumulation that created the move initially. Livermore learned to distinguish between this natural market breathing and genuine distribution, which would display distinctly different characteristics: heavy volume on declines, failure to recover previous highs, and deteriorating relative strength persisting across multiple sessions. His tape reading methodology evolved into a complete philosophy, prioritizing evidence over emotion and mechanical signals over gut feelings. The tape never lied, but it required fluency in its language to extract actionable intelligence from the constant stream of price and volume data, overwhelming less systematic observers. Livermore refused to anticipate reversals, instead requiring confirmation from the market itself before making position adjustments. This discipline transformed staying in winners from an act of hope into rational response to objective market evidence. The broader lesson extends beyond individual stock selection to encompass systematic market participation that can be learned and applied without requiring Livermore's intuitive genius. His pivotal point doctrine provided clear rules: do business only when the market proves your premise, and continue only as long as it keeps proving it through price, volume, and time confirmation. Yet even perfect tape reading couldn't solve Livermore's deepest challenge, the psychological warfare between fear and greed that turns winning trades into premature exits. Even perfect tape reading couldn't solve Livermore's deepest challenge, the psychological warfare between fear and greed that turns winning trades into premature exits. A battle that rages in every speculator's mind regardless of their technical expertise or market knowledge. His transformation from impulsive profit taker to patient position holder required conquering an internal enemy far more dangerous than any market crash or financial panic. The solution emerged through developing what he called his sitting tight protocol, a systematic mental framework designed to override the destructive impulses that had cost him millions in premature exits, like his Union Pacific disaster. The psychological breakthrough began with a radical reframing of what profits actually represent in successful speculation. Amateur traders view paper gains as fragile trophies requiring immediate protection before market conditions change, but Livermore learned to interpret early profits as market validation that his analysis was correct and deserved increased commitment rather than hasty retreat. This mental shift proved revolutionary because it transformed the natural fear of giving back gains from prudent risk management into recognition of a destructive impulse that severed him from the true potential of validated trends. His famous insight that it was never my thinking that made the big money for me, it always was my sitting encapsulates this profound transformation from prediction to endurance, from being right to staying right through the inevitable fluctuations that test every profitable position. The sitting tight methodology required developing precise criteria for distinguishing normal market breathing from genuine trend failure, since every healthy advance experiences periodic selling that can terrorize position holders into premature exits. Livermore's duration depth character protocol provided objective measurements that removed emotional guesswork from these critical decisions. Normal pullbacks within strong trends typically lasted 3 to 7 trading sessions, retraced approximately 30 to 50% of the prior advance, and displayed contracting volume on declines with narrowing price ranges as selling pressure exhausted itself. Any deviation from these parameters, particularly expanding volume on weakness or reactions persisting beyond the expected time frame, served as early warnings that market character might be changing and required systematic reevaluation rather than panic selling. His legendary 1929 short campaign demonstrates this psychological discipline under maximum pressure, as Livermore maintained and expanded his bearish positions through violent rallies that shook out less committed speculators. When leading stocks began showing distribution characteristics throughout the summer, he initiated modest short positions that moved favorably as the market confirmed his thesis through declining volume on advances and expanding participation on declines. The revolutionary insight was scaling up rather than taking profits, as these positions demonstrated genuine momentum, treating early gains as evidence that larger profits awaited patient holders rather than signals to secure quick returns. During the inevitable short, covering rallies that punctuated the 1929 decline, Livermore's tape reading skills revealed these surges lacked the volume characteristics and institutional sponsorship necessary for sustainable advances. His sitting tight protocol demanded maintaining positions through these uncomfortable periods, rather than covering from fear that paper profits might evaporate, since the rallies failed his duration depth. character test by showing thin volume, failure at prior resistance levels, and inability to generate broad market participation. This required enormous psychological fortitude as his paper profits fluctuated by hundreds of thousands of dollars daily. But his systematic framework provided emotional anchor points that prevented reactive decision-making during periods of maximum stress. Protecting mental capital became as crucial as preserving financial capital through Livermore's practice of making all position adjustments at predetermined times when markets were closed, removing the emotional intensity of intraday fluctuations from his decision-making process. This deliberate detachment prevented the psychological exhaustion that comes from constantly second-guessing positions based on short-term noise rather than systematic evidence. He treated news and headlines as context rather than trading signals, recognizing that price and volume action delivered the ultimate verdict on institutional behavior, regardless of expert opinions or dramatic events reported in financial media. The sitting tight methodology fundamentally reversed the amateur tendency to take profits and let losses run by cultivating discipline to let profits run until the market tells you to get out, while cutting losses swiftly at predetermined structural levels. This required learning to embrace small mechanical losses as the cost of participating in potentially massive winners, since holding losing positions consumed mental energy and tied up capital that could be deployed more productively. The psychological framework treated each favorable swing that behaved according to plan as a vote of confidence from the market, demanding not retreat but recommitment to the process with tighter structure and continued patience. Livermore's sitting tight protocol also included environmental controls designed to minimize emotional interference with systematic decision-making. He limited screen time because constant observation breeds fidgeting that births premature exits, scheduled regular boredom as a natural part of trend participation, and developed comfort with the substantial position volatility that terrifies less experienced speculators. His failure to act right checklist provided objective criteria for recognizing when market character was genuinely changing, leaders failing to advance after logical pauses, pullbacks overstaying their expected duration, or support levels giving way on heavy volume with weak recovery attempts. This psychological mastery created the mental foundation necessary for Livermore's most sophisticated and dangerous technique, systematically adding to winning positions without destroying them through overconfidence or excessive risk, a pyramiding methodology that required mathematical precision to avoid turning winners into disasters through improper scaling or timing. This psychological mastery created the mental foundation necessary for Livermore's most sophisticated and dangerous technique, systematically adding to winning positions without destroying them through overconfidence or excessive risk, a pyramiding methodology that required mathematical precision to avoid turning winners into disasters through improper scaling or timing. The technique represents the ultimate test of speculative discipline because it demands increasing commitment precisely when natural caution suggests reducing exposure. Yet when executed properly, pyramiding transforms modest initial stakes into fortune, building campaigns that justify the psychological effort required for staying in winning trades longer. Livermore's pyramiding doctrine emerged from recognizing that his best trades invariably started small and built momentum gradually, suggesting that early profits represented market validation deserving increased participation rather than signals to reduce exposure and bank gains. His 1906 railroad short campaign provides the perfect laboratory for understanding this methodology because it demonstrates both the mechanical framework and psychological discipline required to scale positions without destroying them through emotional errors or mathematical miscalculations that plague amateur attempts. At position building. The campaign began modestly when Livermore noticed accumulation patterns breaking down across multiple railroad issues during a period when conventional wisdom suggested these transportation stocks were attractive values. His initial short position in Union Pacific represented approximately 1% of his trading capital, risked to a clearly defined structural stop above the recent consolidation high, providing precise mathematical boundaries for the speculation, while maintaining flexibility to add if market action confirmed his thesis through decisive price and volume behavior. The pyramiding framework followed strict mathematical rules designed to prevent the position from becoming unwieldy, despite expanding size. Each addition must be smaller than the previous stake to maintain proper risk distribution, following what became his signature scaling pattern. If the initial position was 1,000 shares, the second addition would be 600 shares, and the third only 400 shares. This decreasing scale ensured that his average cost always remained significantly above current market prices for short positions, or below current prices for long positions, keeping the bulk of his capital at comfortable distance from immediate market action and preventing late additions from disproportionately influencing overall position mathematics. His triangle of risk principle governed all position sizing decisions by recognizing that as positions expanded through successful additions, the distance to structural invalidation contracted proportionally, keeping total portfolio risk bounded even as individual campaign profits compounded dramatically. When Union Pacific broke decisively below its accumulation range on volume running, twice the 10-day average, Livermore added his second tranche, but simultaneously moved his protective stop closer to current prices, positioning it above the most recent lower high rather than his original entry level. The mechanical execution required volume validation for every addition, demanding 1.5 to 2.5 times average turnover on the day of each scale, up preferably with prices closing near extremes that favored his position direction. Livermore refused to add during pullbacks or weak bounces because these represented temporary counter-trend movements rather than confirmation of his underlying thesis. Each addition occurred only after the market provided fresh evidence supporting his premise through decisive price action, expanding volume, and deteriorating sector breadth that confirmed institutional distribution rather than temporary profit-taking. Stop-loss progression provided the mechanical framework for protecting accumulated profits without premature exit from validated trends. Protective stops lived under structural levels derived from market action rather than emotional comfort zones, typically residing below the most recent pivot low or prior consolidation high that had been decisively penetrated. These stops moved higher only as new structural levels emerged through continued favorable price action, never based on time passage or arbitrary profit targets that ignored actual market development. The psychological component proved equally crucial because pyramiding requires maintaining conviction. While position volatility increases dramatically with each successful addition. A modest initial position might fluctuate by hundreds of dollars daily, but a properly pyramided campaign can swing by tens of thousands as paper profits compound through successful scaling. This volatility terrorizes most speculators into premature position reduction precisely when maximum commitment offers the greatest potential rewards, making psychological preparation as important as mathematical precision for successful execution. The failure modes require constant vigilance because pyramiding magnifies both profits and losses when executed improperly. Averaging down destroys both financial and mental capital by increasing commitment to failing premises, while equal-sized additions overweight late entries when risk-reward ratios are least favorable. Widening stops to accommodate larger positions violates systematic discipline and typically leads to devastating losses that erase months of careful profit accumulation through a single emotional decision driven by hope rather than evidence. Livermore treated each addition as a fresh trade that must stand on its own merits while improving the campaign's reward profile, not as house money that excused abandoning systematic rules. The beauty of correct pyramiding lies in compounding with bounded fragility. As prices accelerate favorably, the percentage of equity exposed at risk can remain constant or shrink, even as gross profits balloon exponentially, enabling the patience required to sit tight through inevitable fluctuations that test every profitable position. Yet even perfectly constructed pyramids face the ultimate test, recognizing when the market's message has fundamentally shifted and demands immediate exit before accumulated profits evaporate through stubborn adherence to invalidated premises. Yet even perfectly constructed pyramids face the ultimate test, recognizing when the market's message has fundamentally shifted and demands immediate exit before accumulated profits evaporate through stubborn adherence to invalidated premises, a challenge that destroyed many of Livermore's contemporaries who mastered position building but failed at position liquidation. The art of exit timing requires distinguishing between normal pullbacks, where holding demonstrates discipline, and genuine reversals where continued holding becomes destructive stubbornness that transforms systematic speculation into gambling on hope when market character changes decisively. Livermore's breakthrough came from developing a three-signal exit system that removed emotional guesswork from the most psychologically challenging aspect of speculation. Climax runs provided his first warning signal, characterized by vertical advances with expanding daily ranges running 150 to 200% of recent averages, while volume surged to 3 or 4 times normal levels, creating unsustainable conditions followed by exhaustion gaps and failure to make meaningful progress despite continued favorable sentiment. These parabolic moves revealed emotional buying overwhelming systematic accumulation, suggesting that professional interests were using public enthusiasm for systematic distribution rather than continued position building. Pivotal reversal days constituted his second exit criterion, occurring after extended runs when stocks made new intraday highs but closed below the prior day's low on heavy volume, demonstrating that institutional interests had absorbed morning strength to distribute positions rather than accumulate additional shares. These reversal patterns carried particular significance when they occurred at logical resistance levels or after climactic action, since they revealed professional selling overwhelming retail enthusiasm precisely when amateur speculators expected continued advancement. The mechanical identification required patience because single-day patterns could mislead, but when confirmed by subsequent week follow-through and failure to regain the reversal day's high, these signals provided reliable evidence that market character was shifting from accumulation to distribution. Structural violations provided his third and most decisive exit signal, occurring when prices broke decisively below meaningful pivots or trend lines with heavy volume, and weak bounce attempts that suggested institutional support had been withdrawn rather than temporarily overwhelmed. These violations carried particular weight after extended advances and climactic action, indicating that the fundamental supply-demand balance had shifted from scarcity to abundance as professional distribution campaigns reached completion. Livermore's genius lay in recognizing that these weren't arbitrary technical levels, but represented genuine shifts in the line of least resistance that demanded systematic response. The execution strategy proved as crucial as signal recognition through his staged exit methodology that transformed liquidation from all or nothing gambles into probability management. On first abnormal action, he would sell 1/3 of his position to reduce fragility and lock in substantial profits while maintaining exposure to potential continued advance. The second tranche would be sold upon confirmation through pivotal reversal or structural violation, with the remainder trailed beneath the most recent higher low to capture residual momentum if the market resumed its trend while protecting accumulated gains if reversal proved genuine. Livermore's cotton campaign disaster illustrates the catastrophic consequences of ignoring these systematic signals in favor of emotional attachment to successful analysis. After building substantial long positions through proper pyramiding as cotton advanced from 12 to 18 cents per pound, he watched the market display all three exit signals sequentially: climactic buying pushing prices to 20 cents on crop damage speculation, pivotal reversal days showing heavy distribution at highs, and structural breakdown below key support on expanding volume. His failure to execute systematic exits cost over $2 million in profits that evaporated within weeks as cotton collapsed to 14 cents, demonstrating how perfect position building becomes worthless without disciplined liquidation when market messages change. The psychological trap emerged from his emotional investment in the analysis that had generated substantial paper profits, making him reluctant to accept that market conditions had evolved beyond his original premise, regardless of how sound that premise had been initially. This transformation from systematic speculation into stubborn hope represents the most common failure mode among otherwise competent traders who master entry and position management but cannot surrender positions when evidence demands exit. Livermore's failure to act right diagnostic became essential for recognizing when leaders could no longer advance after logical pauses, when normal pullbacks became abnormal in duration or depth, and when volume characteristics shifted from accumulation to distribution patterns. The framework emphasized responding to actual market behavior rather than what it should do based on fundamental analysis or previous patterns that might no longer apply under changed conditions, treating conviction as hypothesis while letting the market supply the verdict through price and volume action. This systematic approach preserved the bulk of campaign profits while maintaining psychological flexibility to re-enter positions if market action suggested premature exit, since being wrong about timing was preferable to being wrong about direction when substantial profits were at risk. The beauty of systematic exit engineering lies in removing ego from sell decisions and replacing emotional attachment with mechanical rules that travel across markets and timeframes without promising impossible precision. These individual techniques of tape reading, sitting tight, pyramiding, and exit engineering must now be fused into a complete campaign doctrine that transforms Livermore's insights into a repeatable framework any disciplined trader can execute with confidence. These individual techniques of tape reading, sitting tight, pyramiding, and exit engineering must now be fused into a complete campaign doctrine that transforms Livermore's insights into a repeatable framework any disciplined trader can execute with confidence, moving beyond theoretical understanding into practical daily application that removes guesswork from every critical decision while honoring the psychological realities that destroy most speculative efforts. The synthesis begins with rigorous pre-market preparation, scanning for leaders displaying 6 to 8 week accumulation bases, with relative strength making new highs while broader markets consolidate, combined with volume footprints showing contracting turnover on declines, and expanding participation on advances that reveal institutional sponsorship rather than retail enthusiasm. This reconnaissance identifies candidates worthy of attention while eliminating emotional pressure from real-time decisions, treating overnight developments as context rather than trading signals, since markets often ignore seemingly important news, while reacting dramatically to apparently minor events revealing underlying supply. Demand shifts, entry discipline demands taking initial stakes only on decisive confirmation at pivotal points, requiring breakouts from proper bases on volume running 150 to 200% of recent averages, while prices close in the upper portion of daily ranges, treating early entries as speculation regardless of compelling fundamental stories, until market proof validates premises through price action. Risk management begins immediately with protective stops positioned below structural support levels rather than arbitrary percentages, keeping initial exposure to 0.5 to 1.0% of total equity while maintaining flexibility for systematic additions, if subsequent action confirms original analysis through continued strength and institutional participation. Post-entry protocols include the 3-session follow, through test requiring continued strength within 72 hours of initial breakout, followed by the 10 to 15 session evaluation, determining whether stocks can build on early gains through constructive consolidation and resumed advance, rather than failing to act right according to expected behavior patterns. Weekly reviews ask the crucial question, did any position fail to meet its expected development timeline or show deteriorating relative strength, volume characteristics, or structural integrity that demands systematic response regardless of personal attachment to original analysis or paper profits accumulated through favorable early action. The integrated risk framework expands position size only with market proof through favorable price and volume confirmation, treating early profits as validation deserving increased commitment rather than signals to reduce exposure, and bank gains prematurely like amateur speculators who systematically cut winners short while letting losers run indefinitely. Pyramiding follows mathematical rules of decreasing size with each addition while maintaining average cost at comfortable distance from current prices, ensuring late additions don't disproportionately influence overall position risk, even as gross exposure expands through successful scaling that compounds returns while keeping protective stops beneath structural levels that move closer to current prices only as new support emerges through continued favorable development. Psychological discipline protects mental capital through environmental controls, minimizing emotional interference with systematic decision making, including making position adjustments only during predetermined times when markets are closed to prevent reactive responses to intraday noise, while ensuring adequate reflection time for important decisions that require objectivity rather than emotional urgency. The failure prevention framework identifies common errors transforming systematic speculation into gambling. Averaging down into losing positions violates fundamental principles while consuming both financial and mental capital. Profit, taking from boredom rather than market signals, abandons positions precisely when patience offer maximum rewards. Trading laggards instead of leaders reduces probability while increasing risk, and widening stops to accommodate emotional comfort destroys systematic discipline through hope-based accommodation rather than evidence-based adjustment that honors original premises. Success metrics focus on process adherence rather than short-term results, measuring whether decisions followed systematic criteria, regardless of immediate outcomes influenced by random market fluctuations beyond trader control. With following the tape meaning response to actual price and volume evidence, rather than predictions or hopes, while respecting pivotal points requires waiting for confirmation before action, yet responding promptly when signals appear through decisive breakouts or structural violations. Livermore's ultimate insight transcends individual techniques to embrace philosophical framework treating successful speculation as systematic response to market evidence rather than prediction or gambling, recognizing that staying in winning trades longer represents mathematical acknowledgement that validated trends offer asymmetric reward opportunities for those with discipline to participate fully while managing risk systematically through mechanical rules, rather than emotional impulses that destroy most speculative careers through premature profit-taking and stubborn loss, holding that reverses proper speculation into destructive gambling on hope when evidence demands systematic exit. Next time, we'll stress test this complete Livermore doctrine against modern algorithmic market conditions and explore how today's electronic execution environment affects these century-old principles of trend following, position management, and systematic speculation that remain as relevant today as during the golden age of tape reading, when fortunes were made through disciplined application of mechanical rules derived from market evidence rather than emotional decision, making that consistently destroys trading capital through predictable psychological errors.